you can't predict the waves, right? Waves come, waves go. You can't predict. I can't tell you what the stock market is going to do this week, right? But I can tell you what's going to happen over the next 5 years. Okay, so the tides are very predictable. Okay, the tides driven by demographics, for instance. Demographics are locked in, right? And they're the kind of glacial forces of economics, and they're so predictable, and they make a lot of difference. When you look at what's happening with interest rates going up, well, as soon as interest rates start rising, we're clearly going to have a multifamily bubble, okay, a popping of that bubble, because I know a lot of guys that their deals don't cash flow anymore, right? And they've got maturities coming up, and they can't refinance.
Hello, left fielders. Welcome to the Passive Investing from Left Field podcast. Our community is focused on networking and education to help people invest passively and think differently. Let's go. I'm really excited today to have Bob Fraser with us again. He is the co-founder and principal at Aspen Funds, a firm that started in 2012 to take advantage of a unique opportunity in residential real estate. Due to their track record and the reputation they have, many new opportunities have led Aspen to start raising capital for trusted operators. So a lot more deals are coming out of Aspen. They've been a huge supporter of LFI from the beginning as a preferred partner and a major sponsor of our 2022 meetup. So we're super thankful for Aspen. Bob is a returning podcast guest. His previous visit was August 2021. So 2 years ago on episode 25. So we'll include that in the show notes, but go ahead and check that out. Bob, welcome again to the Passive Investing from Left Field podcast.
It's fun to be here with you, and hello to all you left fielders. So it's fun to see you in person there at that wonderful event too.
It was fine. So many people we'd met on Zooms and all these video calls, and then to finally meet someone in person and shake their hand was nice. And we're doing it again October 4th through October 6th. So put that on your calendar. And so the first question I always like to ask, Bob, if you could just kind of give your journey, how you got into real estate, what you've done in real estate. I know that's a long list, so give us the cliff notes, but just share our journey for us to start off.
Yeah, well, I have an extremely unusual background and a lot of history. I was a computer scientist, so I was a computer coder and loved coding of all things, and then started at .com in the late 90s. It became a very big deal, ended up raising $44 million in venture capital. So I kind of became a finance guy at that point. And we had some 300 employees. I win the Ernst & Young Entrepreneur of the Year Award for the Midwest United States. Was the fastest growing company by revenues in the Midwest region of the United States during the late 90s. It was an absolute rocket ship, and then it blew up and I lost everything. And realized kind of at that point the vagaries of the public markets. But apparently I didn't have enough of that. So went on to start a hedge fund. So I'm really passionate about economics. Anybody who knows me knows that I'm a voracious reader and studier of all things economics. And started a hedge fund, was very, very successful for a while until I wasn't. And again, the vagaries of the public markets. The thing about the public markets, you can have all your fundamentals right, and the stock does whatever it wants to do, right? Because the stock market is primarily not made up of fundamentals. It's primarily made up of hamburger helper and sentiment driving it, and who knows what, right? Big boys getting in and out. Real estate, on the other hand, is much more predictable. And it's that point that I thought, I want to get in something where I can push the buttons and pull the levers, and I can predict how much money I'm going to make. And you can't predict it 100%, but you can get darn close. And so real estate was the perfect answer. And we actually got into mortgage notes at the time, which was a distressed debt back in, the early 2010s there. That was really the thing to get into. But we weren't necessarily note guys. We became note experts, but we're generalists. We're generalists. We're real estate guys. I'm really a finance guy and an economics guy at the end of the day. And so we're looking for anything opportunistic at this point. And we do a lot of real estate, but we do a lot of non-real estate too. And so yeah, we're generalists at Aspen. All four partners have experience in venture capital, hedge funds, private equity, banking, lots of things. And so there's no shortage of opportunities out there. And so when something goes cold, you want to be able to have something that isn't cold, right?
Yeah, and that makes complete sense. So, you had branched out, right? You're doing a lot of different things other than notes. So can you talk about why you've broadened your scope, why you're reaching out to other asset classes? I mean, the notes funds are still performing, correct? So
Right.
Is it just that there's a lot of opportunities elsewhere, or what made you kind of make this shift? Because it's a pretty significant shift.
Yeah. Well, what happened? So we cut our teeth buying non-performing residential debt. And we made a lot of money doing that and a lot of money for our investors. The problem is the stuff we bought, the niche stuff we bought is just not available anymore. We still have a very large note fund that uses quite a bit of distressed debt, but it's a performing note fund. So it buys a very different asset class. That stuff is available, though it's not as available as it was. So what happened is, this is our market, right? Nothing works forever, right? You've got opportunities that got a 5-year runway or a 10-year runway or whatever. And then you just got to look for something else. So it was clear that was not, that we had made a ton of money. It's actually a problem if you stay too long in somewhere, right? Where you park. And I see this as my, Ben and I were talking about earlier, our chief investment officer there. And he was saying how, this idea of vertical integration, right? Where you want to get efficiencies by going vertical, like becoming a property manager in a construction company, and then you buy the apartment complexes and you manage them and all that. That's a disaster, because what happens then, let's say you've got 300 employees that you've got to keep busy, and it doesn't matter how bad the deals are. You still got to do deals because you got to fund your construction company or your development or whatever it is. And I just want to be a lot more agile than that. And the truth is, having lost everything twice, nothing lasts forever, and you've got to be agile. And this is really what's missed in so many of the real estate focused people. Even everybody's into multifamily. Seems like I know is like a multifamily. Well, multifamily is going to have a few rough years here, and it doesn't mean multifamily is dead. In fact, it's going to be a great buying opportunity. But it's just a good case in point that as investors, we've got to be a little bit smart. So here's my history, Jim. I mean, I started at .com in the late 90s, right? Well, if you had the world's worst .com, it went up in the 90s. Right? It didn't matter how lame it was, right?
Yeah.
Well, if you had the best .com in 2001, it went down. I mean, I looked up the history. Amazon was selling for 35 cents a share.
Yeah.
I mean, that's nuts.
That's crazy.
Right? So if you're going for your vertical integration, you're going for this 10% efficiency, but you're losing 90% of your investment, what good is that? It's really more important to get your timing right than it is to get the nth efficiency out of the system. And so that's where we're first timing people. I mean, you ask what's Aspen doing? If anything, we're more like we got kind of the mind of a hedge fund. We have the kind of the brain of a hedge fund. Let's think about Blackstone. What's going on in the world, what's going to be working, and then figuring out how we want to deploy our capital, right? And that's the way we think. Versus, right. Hey, I've got a construction company or I've got a development business, and therefore I'm going to go do development deals regardless of how sucky they are.
Right. So how do you figure out the timing then? If that's the important or one of the most important parts, how do you figure out the timing for each asset class, right? I mean, it would have been great to sell any crappy .com in 1999, right? Before the crash, or any great .com probably. So how do you know
right.
that this is the time to get out of multifamily, jump back in a year, or get into retail now, or whatever, the warehouses? How do you know what the time is right?
Yeah. And as I put it, you can't predict the waves, right? Waves come, waves go. You can't predict. I can't tell you what the stock market is going to do this week, right? But I can tell you what's going to happen over the next 5 years. Okay, so the tides are very predictable. Okay, the tides driven by demographics, for instance. Demographics are locked in, right? And they're the kind of glacial forces of economics, and they're so predictable, and they make a lot of difference. When you look at what's happening with interest rates going up, well, as soon as interest rates start rising, we're clearly going to have a multifamily bubble, okay, a popping of that bubble, because I know a lot of guys that their deals don't cash flow anymore, right? And they've got maturities coming up, and they can't refinance. I mean, Fitch just came out with a statement. They're a large ratings agency, and of the CMBS that they rate, they were looking at just the 2023 maturities happening this year, and 23% of the maturities this year in the properties they rate would not qualify for refinance because they don't cash flow enough on DSCR, debt service coverage ratio, or on LTV concerns. That's a big deal when you've got 23% of the maturities this year are not going to be refinanceable. Well, you've got a problem. So this is predictable, Jim. This is not everything is predictable, but a lot of things are predictable. When you see massive glacial forces moving and they're colliding, you can make predictions, right? And that's what I've done with these economic megatrends I've done, the 2023 megatrends. I've got, half a dozen megatrends that I've identified that are very, very predictable. And it's not rocket science. It's just a ton of reading, ton of research. And, and I've got a pretty good track record doing it. I've been doing it for 20 years. But there's other people doing it too. There's a lot of people out there that consume this information and successfully synthesize it.
Well, okay. So you mentioned they can't refi. So we're going to get into the mega trends, but I'm going to hold off on that for a minute. You mentioned that properties or operators aren't going to be able to refi, and that their maturities are coming up. Can you explain what the maturity means? That's the loan coming due, and then why can't they refinance?
Okay, so there was a syndicator bubble. There's thousands of syndicators went to some kind of a conference or a webinar on why stick in your old job, go raise money from investors, and go buy apartment complexes. Well, these little guys went and bought deals, and they paid too much for them. They outbid everybody else on deals that should never have been done. In order to do it, they're getting 80% LTV loans. And you guys know what that is, right? That means $10 million apartment complex, you'll borrow $8 million on it and put in $2 million. And they borrowed, and the only guys that do that are the bridge lenders. Okay. And the bridge lenders are the private lenders that have these floating rates. They do not allow fixed rates, and they don't do long-term locks. They typically would do a 3-year lock, a rate lock, and then it goes up. Well, so let's say you're paying 3% interest. Well, all of a sudden these things are cash flowing just fine, right? You collect your rents, you pay your debt, great. But what about when that 80% loan, it's a big loan, when it doubles its interest rate? All of a sudden, there's not enough cash flow to pay the interest, okay? That's the problem. And banks wanted what's called a debt service coverage ratio, meaning they want to see the cash flows from the property about 120% of the payment, the debt payment on the property, right? That's typically their bottom line, and it varies, but that's a rough number. Well, all of a sudden, when their interest rates go up, their debt service coverage ratio is below 1, which means they can't even afford to pay the debt. Well, now they're going to refinance, and the guys say, no, I'm not going to refinance. You can't afford to pay me. Why am I do that? Or the property values has dropped, so you've got an 80% loan on this thing. Now the property values have dropped a little bit. And they've dropped about 20% is what most people are saying. Well, now you've got 100% LTV. You follow me? So you've got 100% LTV and you can't pay your debt. Who in their right mind is going to refinance you? No one is. And so this stuff is all going to be retraded. And, it looks like about $1 trillion worth of maturities are coming in the next 5 years, according to TREP. So it's a big number. And it's just one of those things you just don't want to be You want to wait, right? It's too early right now to be buying. You want to wait a couple of years from now when, multifamily is a dirty word. Everybody's lost money. If you tell people you're a multifamily investor, you got to put a paper bag over your head. That's the time when you want to be buying multifamily. You follow me? And it's just too early. But there's going to be some pain. And it's just a perfect example of a great market. Multifamily, yes, people need a place to live. It's a great thing. It's just not the right timing. And it's all very predictable, Jim.
Yeah. So these deals, then when they can't be refied, then they're just going to have to sell the property or give it back to the bank, right? And just so we're all clear, the capital stack, the debt comes first. So if you're an LP and they have to sell a deal just to pay the debt and there's nothing left over, you get nothing, right? You're not getting your capital back.
You get 100% wipe. And that's not even the worst deals I've seen. I actually saw deals in Dallas where they're buying in at a 2.8% cap rate. That means without debt, it was yielding 2.8% yield. Insanely low. And they put an 80% debt on it, and then they got 10% private equity on top of it. So they're 90% levered. That's the only way they could convince their investors there's going to be a return, right? There's going to be no return. I mean, even the private equity guys are probably going to get wiped in these deals. And here's the crazy thing. Here's the crazy thing about this whole thing. And this is what my experience in the public markets. I mean, this is the way it works. So this whole thing is coming tumbling down. But here's the issue. Let's say we have 8% inflation. I know it's dropped a little bit lower than that now. We have 8% inflation for 10 years. Do you know what that does to rents over a 10-year period? It doubles the rents, which means it's going to double the NOI, net operating income, which is how properties are valued, which means it's going to double the value of the property. So while it is the best time in the earth to be a real estate investor right now, you just have to weather the debt storm. And all these guys that they paid up for their deal, they did bad deals that shouldn't have been done, and they're going to get creamed. And the truth is there's going to be a lot of money made in real estate because it's the ultimate inflation hedge. And according to my views, and I've been saying this for several years, inflation is here to stay. We're not going back to 2% inflation, not anytime soon. I think we're going to see elevated inflation. I don't think we're going to see hyperinflation. I don't think we're going to see 8% inflation. I think we're going to see 4 to 6% inflation sustained for the next few years. And there's a few reasons for that. But, that's going to continue to drive growth, rent growth like crazy. So you want to play the long-term game, and the most important thing, I said this at your conference too. I said, most important thing is look at the debt stack. You must understand the debt structures, and you must understand the debt. We're seeing so many blowouts and so many deals that should not be done. Every deal Aspen does, we have a plan B that we don't write about, we don't publish. It's a plan B. It's a worst case plan. Let's say if everything goes haywire, we can flip the plan from a 5-year business plan to a 10 or a 15-year business plan and hold on to the property no matter what and make our investors money. Because if we can hold it for 10 or 15 years, it's gonna be a win, right? A big win. We just got to weather it. So we have that in every single deal we do because, hey, I've lost everything twice. It's not going to happen again. And I've lost investors' money before. And it's something I never, ever, ever will do again. I mean, it's everything I do, I want to make absolutely bulletproof. And that's, we got some gray hair at Aspen. And we got some young bucks too, which I love, young and optimistic and fiery and lots of vinegar. And we got some people who've been through it as well. And we're not interested in playing the risky game. The truth is you can make great money without playing a lot of risk. In fact, one of the things we're looking at right now, one of the mega trends is we're seeing you've heard of an inverted yield curve. Right now, there's an inverted risk curve. It's actually less, risk on the risk curve. It's core plus, value add, deep value add, development, as higher risk, higher returns. Right now, development deals are far less risky than value add deals, far less, and far higher returns. So, it's things like that we look at those kind of things and realize, hey, this is an opportunity. Um,
why is development lower risk?
Because the cost. So I can go buy a value add. You could go buy. There's some for sale now in Northwest Arkansas, an area we love, the Walmart kind of area, for $195,000 a unit. We can build for 130. Which would you rather have? Brand new unit at 130 or an old unit at 195?
Yeah.
Equivalent. Where's the risk? The risk would be paying 195, right? So there's same thing with industrial. You can't buy industrial right now, but you can build it, and you can build it cheap. We're building an industrial we're all in around $65 a square foot for large footprint industrial. If it's leased, it's worth 125. It's a double, and it's a 9-month build. Where's the risk in that? Well, the risk is we don't rent it, which is not very risky when the vacancy rate for Class A is 0. So right. Class A industrial. So, I'm happy to take that risk. Yeah, we build this incredible, industrial warehouse in the middle of the industrial space in the middle of the Midwest with a lot of, and no one wants to rent it. Yeah, right. I'll take that risk all day long. And again, even there, we built an 18-month runway that if we have trouble renting, it's no big deal, right? We're going to just continue to run it out. And we got debt that's long-term debt at a good fixed rate. So, yeah. Yeah,
that's the way to do it. So I want to go back real quick. We're going to get to the mega trends because that's super interesting. But you mentioned, how vertical integration, at the very beginning, you were talking about vertical integration and how that kind of forces people to maybe do deals that they wouldn't otherwise do. So when because you're not an operator, right? You're raising capital for other operators. So is that one of the things that you analyze when you're vetting a sponsor? Is how are they vertically integrated? And if they are, is that a ding on their operations in your mind?
No, it's not a ding at all, because if I'm choosing to work with them on a deal, then I know that, I just don't want to be them, but I'm happy to partner with them. I'll work on this deal, but hey, the deal 5 years from now, when it's all upside down, I just don't want to be them and have a payroll of 300 people, construction workers that I can't afford to pay anymore. Right. So I'm super happy to partner with them. And we actually are operators. We operate our note funds 100%. We don't partner out with that. We also do all of our development. We do our development deals in-house because we have a deep bench on the development side as well. So, yeah. So you're kind of hybrid. We're hybrid. Yes. Yeah. Where we have a deep bench and we're comfortable doing a deal ourselves, we'll do it. And if we're not, we bring our professional expertise, our underwriting. We have bank quality underwriting, very, very good underwriting. Everybody says they have underwriting, but no one underwrites like a bank underwrites, and that's the way we underwrite. Yeah. And really professional operations and those kind of things that we bring to bear. So a lot of times we actually take some operators with a little less experience, but we professionalize them, where we come in where we let them do what they're good at, which is maybe construction and development or something. And we come in with everything else, where we're doing asset management, the property, we finding the property management, doing the business plan. So in that case, are we an operator or not? Well, we are, right. But we split it out. We split out the functions. So it's kind of a sliding scale, to be honest, Jim. So yeah, a lot of deals, we're very much running the deal and controlling the deal, even though someone else may be doing the construction or they have originated the project or something like that. But we're in the driver's seat.
Okay. And so sticking with kind of vetting sponsors or operators, right? That's like one of the biggest things that an LP has to do. So how does an LP then analyze you as an operator or a sponsor, either on a deal that you're raising capital for and it's going to be someone else running it, and or a deal where you actually are the operator? Because as you're hybrid, right? So it's a little bit different analysis than a normal one. So how does an LP dig in and get to know Aspen?
Yeah, well, we do very in-depth webinars for every deal we do. And we're very much, hey, we're just good old Midwesterners like you, right? We're not complicated people. We got no snake oil we're trying to sell. And as I say, we play our cards face up. We really don't have any secrets. We disclose everything, including the deal, including the risks of the deal, including what we love about the deal, those kind of things. And so do the webinar, look at our debt stack, which we pay a lot of attention to. Look at our operation history, look at our track record. And track record is really important, right? Because a lot of people say I'm going to do this, but can they really pull it off? Look at the experience of the operators, the people involved, and look at the deal. Look at the deal. Make sure you like it and ask a lot of questions. I don't mind. We do not mind people asking questions. It's your money.
Yeah.
And we are fiduciaries. We're taking care of your money, and investors first, 100% for us.
Yeah, I think that's critical to feel comfortable asking questions and knowing that you're going to be taken seriously and getting a quality answer.
100%.
That's
we love that. We actually, I just want to say, you want to ask questions, please don't be embarrassed. Ask questions. I have an IR team that loves to answer those, and if they can't get you the answer, they'll go to our chief investment officer and get it from him. If he can't get it, they'll come to me, and we'll get the answer. And we do not mind, and we have plenty of time for that. We're never in a hurry. We never are, look down on anyone asking a question.
And that's good. I mean, it's a huge red flag for me when I ask a question and you get any pushback other than, we'll answer it, right? You run.
You run. I mean, there was just a deal in the news. I don't know if you saw, there was a carbon capture deal, $250 million Ponzi scheme. SEC just busted them. A lot of people in our world that I knew were raising for that deal. And, and it's just sad. And, gosh, pay attention.
That one's a tough one.
Yeah. Pay attention to who your operators are. You know?
And I wonder, it'll be interesting to see how that pans out, because like there's a lot of people that I think are smart, capable people that were, raising capital for that and went to visit and did all of the due diligence that, you should be doing, or at least most of the due diligence. They must have missed something.
They didn't. Yeah, I'm sorry.
Yeah.
Sorry, it wasn't done. Did they look at bank accounts? Did they look at it? Just wasn't done.
What I mean is that the standard due diligence, go to the site and things that like an LP would do, it seems they have done, but you got to dig deeper. There's another deal that I heard about that went bad, that might have had an attorney who was disbarred that was involved in the deal, but he was like 2 layers in. So it's hard. You have to dig until you get to that last layer, right? You can't just go capital raiser, operator. You might have to check the property manager, or you have to go all the way in, right, when you're evaluating a sponsor. So working with people that trust and know something.
And we do that. As when we partner with somebody, we run background checks on absolutely every key employee. We go look at their financials. We push on everything. We look at their track record in detail. And we're still in the driver's seat, by the way, even when we do all that. So it is a lot of work. It is a lot of work to do due diligence, right? It just is. But it's something you just have to do. And, we like to do that one time with an operator, and then we'll do a few deals with them. We do operator due diligence separate from a deal due diligence.
Right. And how does an LP, I don't think they can replicate that, because you're investing, when you're doing a deal, you have a lot more capital that you're putting into the deal. And so you have a lot more resources as well. So how does an LP kind of navigate that difficult thing where, I as an LP, I might only be able to go 1 or 2 layers deep. I'm not going to look at the financials. So how do we get comfortable with an LP or with a GP or an operator in that sense?
First you want to look, Ponzi schemes are fairly easy to spot, I think, right? It's just, are they paying cash out? If they're paying cash out and cash in at the same time, you got to take a look at it. And if they're being cagey at all or dodgy and you don't want to show you, ask for their financial statements, ask for their deposits report. ask for the invoices for the last month. And if they're cagey about it, don't do it.
Yeah.
So there's a few things to ask. You can ask for things you don't even know how to read, but just ask for them.
Yeah. And part of it, right, is to see if they give it to you or not.
Yeah. But most deals, people are terrified of Ponzi schemes, but they're really rare. I mean, I don't think most investors should be super concerned about that unless you're going to park a significant amount of your net worth there. And those, just do it with reputable people, for gosh sakes.
Yeah.
It's, trust is everything in this business, right? And so you want to go with people that really care about their name and their good name and their reputation.
I always enjoy talking to Bob. He's just got so much information and is so willing to share it. It's really nice. This podcast will be split into two because we did talk for longer than we should have, but it was just so interesting and so much to talk about that we just kept on going. But I do want to mention a couple of things from my notes here. Bob talked about the public markets and how unpredictable they are, and that's why he's not into them anymore. And also he, lost money twice in the public markets, but that really cemented something for me because that's where it's more speculation. It just is. If you're raising money for a stock market deal or something like that, or a hedge fund, you're really just hoping to sell to somebody else at a later time and make money on that with nothing in between, right? And so real estate, you have cash flow and you have an asset, and it's just more real. So I liked how he said that. And he also admitted, they are generalists, which means they are able to go and work with other operators. And you heard him talk about how he helps them and kind of guides them, but they're generalists, which means that they're not digging deep into any one thing necessarily, although with their fund, their debt fund, they are. With most things, they're just generalists and working with partners who have the knowledge. And I like that approach. And then he talked about the DSCR. And I thought that he really explained that well. So I'm going to go back and listen to that again because it just was explained in a way that was really made sense to me. And so I always like that. And the last thing for the first half, at least, he was talking about make sure you ask the question. And if an operator is not answering or is cagey about it or anything like that, just move on. There are plenty of fish in the sea, as they say. There's thousands of syndicators. So if someone isn't giving you the financials or giving you the information you want, say goodbye, move on. So that's it for this one. Next week, we'll put out the second half where we talk about the mega trends, and it gets really interesting when we're talking about economics and all that stuff, because that's really where Bob shines. So please tune in next week. But for now, we'll see you next time in the left field.